Going back all the way to 1957, Canadians have known one thing about the first 60 days of the new year. Apparently, it's a time to think about RRSPs. Can't blame them either. The banks roll out those fresh stickers on the windows, the commercials on TV command it, the volume dial is cranked up. Time to top up the RRSP. This study from Edward Jones found that 51% of Canadians planned to contribute to their RRSPs last year, and of those contributing, 23% planned to max out their contributions. And for some, perhaps it's not a bad idea. Sure, but there are at least 5 scenarios where it makes no sense for you to max out your RRSP, or at least where you need to exercise some caution. So in this video, I'll unpack those instances where it makes no sense for you to contribute to an RRSP. And along the way, I'll help you think about what you might want to do instead. By the way, if we haven't ever met, my name's Steve Willems. I'm a wealth advisor here with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan your own retirement, helping you think about how to plan and arrange your investments, your income streams, and ideally have you pay less tax along the way. Now, before we dive into the specifics, let's take a moment to understand what we're dealing with here. Now, RSPs, or Registered Retirement Savings Plans, are a staple in the Canadian retirement planning landscape. They're essentially accounts that offer tax benefits to save for your retirement. I'm sure you've heard about them. The beauty of an RSP is that the money you contribute is tax deductible, meaning it reduces your taxable income for the year that you put it into that account. Now, this can be a powerful tool for reducing your current tax bill. And the investments in your RSP, they're going to grow tax deferred until you withdraw them in retirement, ideally at a lower tax rate. Now, every year, there's a deadline to contribute to your RSP for it to count against your previous year's income. The deadline is typically the end of February. It's a critical date because it allows Canadians to make strategic contributions based on their earnings from last year and potentially get a sizable tax deduction. But here's where it gets interesting. Now, just because you can contribute to your RSP doesn't always mean that you should, at least not to the max. This is where strategic RSP contributions can come into play. For some individuals, especially those at higher income brackets or nearing retirement, maxing out their RSP isn't always the optimal choice. Why? Because your financial situation, your tax bracket now versus in retirement, your future income streams, they're all going to play a crucial role in determining the best approach to your RSP contributions. Now, this advice isn't universal. It's a nuanced decision, one that goes beyond the standard practice of simply filling up that RSP contribution room every single time the deadline comes around. So here are the scenarios you need to watch out for. Up first, when you should be instead preserving the contribution room for higher tax years in the future. You'll want to avoid making an RSP contribution this year if you should instead be preserving your RSP contribution room for a future year when you anticipate higher taxable income. And this might be from the sale of an asset or a piece of property. Imagine you're planning to sell your vacation home in the near future. The sale could potentially catapult you into a much higher tax bracket in that year. Just as an example, using real numbers, let's say you make $125,000 a year currently. That puts you at a 38% marginal tax bracket here in BC. But let's say in 3 years, you plan to sell the family cottage. And when you do that, you're going to realize a $500,000 capital gain in that year. Now, half of that gain is going to be tax-free. The other half, so $250,000, is going to be added to your income in the year that that property sells. And that's going to get added on top of your $125,000 employment income. That's going to put you firmly through the top marginal tax bracket here in BC, 53.5%. If you had saved up your RSP contribution room and then took some of the sale proceeds, let's say $200,000, and added that to your RSP, that would produce tax savings in that year of about $105,000. Much higher savings than if you had contributed just off of your employment income along the way. Now, this approach requires foresight and an understanding of your upcoming financial life events. It's simple, but a great example of how a tailored strategy, one that considers future income spikes, can be far more beneficial than the traditional route of just automatically maxing out your RSP contributions every year. Up next, when your income takes a dip, whether due to a career change, maybe a sabbatical, or any other reason, the usual rush to contribute to your RRSP deserves a second thought. In low-income years, the immediate tax benefit of an RRSP contribution, it just diminishes. Why? Because RSPs are most effective when you can use them to reduce your taxable income at a higher tax bracket. It's going to save you more in taxes. In a low-income year, your tax rate is already lower, so the deduction doesn't pack the same punch. This is where the TFSA, or the tax-free savings account, shines as an alternative. So unlike the RRSP, TFSA contributions aren't tax deductible, but the growth and withdrawals in the future are tax-free. So this is going to make TFSAs an excellent choice for low-income years, as they offer flexibility and tax-free growth without depending on your current income level. By choosing a TFSA in these years, you're not only continuing to save effectively, but you're also preserving your RRSP contribution room for the future when your income and consequently your tax rate might be higher. When it comes to spousal RRSP contributions and their withdrawal, especially as you approach retirement, it's crucial to be mindful of the attribution rules and the specific timelines involved. The idea behind a spousal RRSP is to balance retirement income between two partners, potentially leading to tax savings. However, if you're close to retirement and you plan to bridge your income by withdrawing from the spousal RRSP before you start CPP and OAS, maxing out contributions can lead to unintended tax whoopsie-daisies. According to the attribution rules, if you withdraw from a spousal RRSP within 3 years of contribution, that is, the year of the contribution plus the following 2 years, the withdrawn amount is attributed back to the contributor, not the spouse. This means that the tax liability falls back on you, potentially at a higher rate if you're still in a higher income bracket. This scenario often catches people off guard, negating the very tax advantage that they were aiming for. So if you're planning on short-term withdrawals from a spousal RRSP as part of your retirement income strategy, it's essential to be strategic about your contributions to this type of an account. Be really careful of that 3-year rule. There's also a scenario that's rarely discussed, but it's incredibly relevant to those who've been diligent savers throughout their careers. I'm talking about when you've already accumulated a substantial amount into your RRSPs, to the point where further contributions become a bit of a tax planning paradox. So take, for example, a client of mine who's navigated retirement with an RRSP and now a RIF valued at $3.2 million. It's been a remarkable feat of savings and incredible investment growth, no doubt. But here's the catch. When your RRSPs are that significant, they can lead to what I call an estate tax bomb. Now, this is because on the second death, in the case of a relationship between two spouses, any remaining balance in the RIF is fully taxable as income, potentially at the highest marginal tax rate. And if you're in the situation where your RRSP withdrawals in retirement are being taxed at the same rate as your contributions were deducted, the tax advantage of the RRSP essentially is washed out. So by continuing to contribute in these cases, you're not gaining the tax deferral benefits the RRSP was designed to provide. Instead, you're possibly compounding a tax liability for your estate, making the management of cash flows in retirement and your estate planning issues also significantly more complex. For those enrolled in defined benefit pension plans, the strategy around RRSP contributions also requires an understanding of how pension adjustments work. Essentially, when you're a part of a defined benefit pension plan, your contributions already provide you with a certain level of tax deduction. Same thing with the employer side. Additionally, these contributions can lead to a pension adjustment, which directly then affects the amount that you're actually allowed to contribute to your RRSP. A pension adjustment reduces your RRSP contribution room because the government recognizes that your pension plan is already a significant retirement savings vehicle. So if you're diligently contributing to your DB plan, your defined benefit pension plan, chances are your RRSP contribution room is already limited. In this context, striving to max out your RRSP might not only be unnecessary, but it could actually be an inefficient use of your financial resources too. Instead, your focus might be better placed on other investment vehicles or savings strategies that complement your pension plan. So perhaps topping up your cash wedges, your tax-free savings account, your emergency fund, topping up some other after-tax vehicle. Those are the 5 times you'll want to be careful about maxing out your RRSP. There are probably more, but those are the first that come to mind. If this was helpful, would you do me a favor and just hit that like button, subscribe to the channel, and consider sharing the video with someone who you think might benefit? Our goal here is to help you make the best financial decisions possible, so write in the comments maybe what stood out to you as we unpacked these 5 scenarios, or if you've made any mistakes along the way. Otherwise, thanks for watching. I'll see you in the next video.